Did a little bit of time as a Unibond portfolio manager as well, before I went back to academia. Here at SLU, I teach 2 classes. So the Principle of Finance class, that's where I met Sanj, and then I also teach the equities class periodically, sometimes in the fall semester. So teaching those courses is a big part of my time, but I also do a lot of research as well, which I'm going to talk a little bit about today. Try to give you a more broad overview about innovations in information sources, but that's a big piece of my research as well. So both how they get incorporated into the prices, these new information sources, how do they get incorporated into financial markets, and then how does that affect different market participants. So just to get us all on the same page, thinking about information, how it gets brought into prices, this is kind of the bread and butter of what all the different people in markets do, right? All the analysts, the traders, the portfolio managers, they're trying to gather sources of information and incorporate that into the price of whatever asset they're analyzing. So you can think about what types of information is going into them. Could be things like from financial statements, so 10Ks, 10Qs, etc., and 8K updates that come from the firm. Could be outside news reports that come from third parties or journalists or something like that. And it can also be one-on-one conversations. Maybe it's the earnings announcement call for the firm, or maybe they're at a conference and they talk to some executives of the firm. All this information gathering is going into how they think about this company. One thing I'm going to bring up today is kind of this new world we're in, where there's also big and alternative data sources that get used in the incorporation of information into stock prices. So we have all this information. Some people choose what to look at, some people try to look at everything, and then people come up with their own framework on how they think about the value of an asset. Of course, they want to buy the ones they think are undervalued, sell the ones that they think are overvalued. And this is going to create price adjustments. So that actual mechanism of purchasing and selling is what's moving the prices. So those price movements are information innovations in the market. So the question then is just how does that information actually get there? Is it going to be, an efficient adjustment of the price? And these are things that a lot of finance researchers look into. I bring this up because my understanding is you mostly think about fundamental analysis in this group. You need to be thinking about who you're trading with when you're doing your fundamental analysis, right? It's not just some unknown force out, well, it's unknown to you, but it's going to be a real trader, right? Who's probably either, it could just be somebody doing, solo trading on Robinhood, but it could also be a multi-billion-dollar hedge fund. It could be someone with more information than you. So you need to be thinking about why would this person sell this to me, or why would they buy it from me? Because all these market dynamics are really important. Please stop me at all if you have questions about anything in this slide. You can definitely don't wait till the end to ask questions if you have any. So here's an example I show in my equities class about how market efficiency happens. So how does that information get processed? This is more of a historical example. So this is a research paper from a couple of decades ago now. But it really shows you just how quickly some information can get incorporated into prices. So what Buss and Green did, this is looking at all of the CNBC segments that happen in the morning and midday when they announce news about stocks. So they had this very structured way they did this in the 90s in terms of when they brought up news reports about firms in the morning and midday. So you can actually time this and plot what happened to the stock prices for those that had good news and bad news. So what you see is here is the cumulative return on those different stocks based on did they have positive news that day in either the midday or the morning, or did they have negative news that day. And then this is minutes relative to the report. It's not days or months or anything. This is within a 15-minute plus or minus time frame. And you see when this announcement happens on CNBC, just how quickly things get incorporated into prices. So this positive midday news here, it happens in about a minute. Everything's into the prices. There's already a significant jump. There's actually even some pre-trend, so people might actually know about it before it gets announced. And then you have some time right after where you see this significant jump, and it pretty much stays there after, for the next 15 minutes. Negative news is a bit more gradual, but again, after like 15 minutes, you see it flatten out. I wanted to talk more recently, though, about these new sources of data that get incorporated into prices. And it's kind of grouped into the term of either big data or alternative data. So this is things that don't show up on 10Ks, doesn't show up on earnings calls, but it can be useful in trying to predict what a stock will do in the future. So here's a survey, a few years old now, but kind of holds true about how the trends in the market have happened. And what it was asking is, what type of alternative data sets do you use if you're an asset manager? So this might be like a pension fund or a mutual fund, or specifically if you're a hedge fund. And what it shows is that they're using a ton of different alternative data sources. So the most popular for this survey was using social media and news feeds. So trying to do textual analysis at a big scale of what people are talking about on Twitter about a firm. Is it positive? Is it negative? You know, over this period. Logistics data, so maybe trying to get some supply chain information about a firm, about how much shipments is going to this company to try to predict what they might sell next quarter. And then there's a ton of these different types. So satellite imagery, I'll talk about that in a minute, geolocation data. In general, what these are trying to do is capture more real-time estimates of what the performance will be for a stock before that traditional data comes out. So before the 10K happens or the earnings announcement happens. If you can get a good signal for this type of data, you're going to know before everybody else what the earnings announcement is going to look like. And then you could be maybe one of these early people trading before it's announced. And these really don't have to be that big of performance adjustments for a hedge fund or a big asset manager for them to still use this data at a very large scale. So, sorry, big word blob here, but I just wanted to give you kind of an illustrated example. So let's say you're thinking about a big investment manager. They have a portfolio worth $5 billion, and they're looking for any edge that they can get above and beyond what they're currently bringing for their investors. And they find this alternative data source, and they find that it can give them a return in excess of what they're already getting of 0.1% per year. 0.1% doesn't sound very big, but then you have to scale this to the overall size of that investment firm's value. So 0.1% of $5 billion, that's $5 million. So if they're trying to, they've already maxed out all the performance they can get from other traditional analysis techniques, they're going to spend more. They're going to spend, up to $5 million minus X in order to get this data and use that to get that abnormal return that they need for their clients. So this is how we end up with huge markets for this. So this is why there's a lot of quant analysts, tech support, et cetera, at these big money management firms, because you could hire a lot of quants for $5 million and you could still almost you'll get positive returns. What this means is that even if it's a small mispricing, any obvious sources of information are going to get priced into the stock pretty quickly, and even non-obvious sources might get priced as well. So here's one example. I've done some research using satellite imagery to look at how it'll predict stock prices. What it does is you take like a standard Target store, it could be Walmart, Home Depot, any firm that gets their sales from a lot of in-person customers. And if you partner with satellite data companies, you can get images daily of those parking lots. Now firms like Orbital Insights, RS Metrics, there's a ton of these different firms. They'll go out and hand draw masks around the parking lot so they know they're getting the cars that go to Target. Then they'll use machine learning techniques to identify cars in the parking lot. And then better than most other people what the real-time revenue stream is of Target. You do this at a scale, you try to do it nationwide or even worldwide, and you'll know better what their revenue growth is than some retail investor. You'll be able to trade on that before the earnings announcement. Now remember, the incentive could be, say, a 0.1% abnormal return, could incentivize a lot of people to invest in this. What we found when we looked at this data is that the incentive was actually much greater. You can get really good returns around earnings announcements from using satellite data. So what we did was we just took all the firms in the sample, said we're going to buy those with the highest quarter-over-quarter growth in parking lot growth based off of these images, and then go short those that have the lowest growth. And this is what the buy-sell portfolios did around the earnings announcements that happened right after that portfolio sort. So right at day zero, this is the earnings announcements for all these different firms. You see a pretty decent increase in the buy portfolio and also a very abnormal loss in the sell portfolio. It ends up being, after you adjust for a lot of different things in the market, about a 4.73% abnormal return around those announcements. So there's very significant sources of alpha by using these alternative data sources. Okay, so that's kind of setting the framework there about one significant innovation in markets in terms of how things are incorporated into prices. I'm going to switch a little bit. I'll come back to that in a little bit, but I also wanted to switch into different investment analysis techniques in terms of high level, how I think about the three different ways people can think about stock prices, and then I'll dig a bit deeper into the quantitative analysis, which is what I said I was going to talk about, so I'll spend some more time there. Okay. So when I think of the fundamental analysis that you all are doing, this is really the kind of the legacy way to do stock analysis. You know, you have a lot of legacy investors like Warren Buffett who do this type of thing, where we're using those traditional sources to try to come up with our own insights into how we're going to value a public firm. So we're going to look at their earnings prospects. We're going to look at the management guidance in the 10K. And we're going to try to come up with our own projections of how cash flows will occur for this firm. And you can do that typically through dividend discount models or free cash flow models. So you'll say, my firm is paying X amount of dividends this quarter, and I think it'll grow by Y percentage for Z number of years. And you discount those cash flows back to today, and you come up with a present value of the stock. That's your intrinsic value, and you compare it to what it's actually trading at today. Other people also do ratio analysis, so you do these benchmarking multiples to compare where your firm is relative to the close competitors or maybe their entire industry, again, to try to come up with a relative valuation of this firm. Now, we don't just want to be able to identify good firms using this fundamental analysis. We want to identify underpriced firms, right, which is going to be very different. So we need to find firms that are doing well, but they are actually better than everyone else estimates currently, which is the most difficult piece, right? It's very easy to identify that NVIDIA is a good company, but that doesn't mean I should buy the stock, right? It could be overvalued because it's had an incredible run up in the recent year or so. So what we really want to think about in fundamental analysis is more thinking about what are the trouble firms that are looked down upon that may have had a big correction that we think they'll actually be able to bounce back from. That's where a lot more opportunities lie in fundamental analysis. Okay, so then there's technical analysis. Does anybody do technical analysis on their own? Okay, good, so I'll probably make fun of it a little bit because I don't want to hurt anybody's feelings. No, I won't make fun of it, but I don't think it works very well. But I wanted to bring it up because a lot of people do it. This is kind of the idea of day trading that you'll hear about a lot. It's typically done by what's called technical analysis. So this is basically following the charts to try to identify patterns in what a stock has done throughout maybe a day or a week or a very short time period. So what these technical analysts will do is they're going to look at past stock prices, volume, maybe some other market data like how much short interest there is to try to exploit really minute mispricings in the stock based off of their chart predictions. So this is a little bit different than that CNBC example I showed because it's going to be based off just market movements and not any news that comes out. But it's going to require that stock prices kind of respond sluggishly, and these analysts, these technical analysts, can get in quick whenever they see a little bit of a mispricing. So here's an example of how I've worked with hundreds of these different technical indicators that get used in practice. You'll see a lot of the more common ones if you use like FinViz or Yahoo Finance or any of these sites to look at stock price movements. They'll usually show some of these chart indicators. And people actually use these to try to come up with abnormal returns as well. So here's just a couple of them. This is actually just a randomly simulated stock price here, so it's not any example firm. But I wanted to show some more of the common ones that you'll see out there. One is called a crossover. So again, a technical analysis, they're just going to be looking at this. They don't care really what company this is or if it's, up 50% over the past year or down 50%. They just want to look within this little range and see if there's any technical changes that they can try to exploit. So a crossover would be, you take the stock price, so that's the blue line, it's changing, second to second throughout the day. This is at the daily level that these are moving. And then you create a 50-day moving average. That's this red trend line here. So what you do is you say, what's the average of the stock price over the past 50 days? And then you roll it over. So as you move each day, it changes and incorporates that new information that happens. And what crossover analysis will do is check to see where the current stock price is relative to the moving average. And the idea is that if it crosses over the moving average, that might mean that it's going to be, going to drop significantly if it crosses from above to below, or it might shoot up significantly if you cross from below to above. It sounds pretty crazy. I personally think it is kind of crazy to try to trade off this, but a lot of people swear by it and will do day trading based off of these types of analyses. So you can see maybe sometimes it'll work if it's below the moving average and then shoots up, and you could exploit this big run up. Other times you might see it cross, but then actually come back, and if you trade off that, then you're going to be probably in trouble. Another one would be a resistance band. So you say, over X number of days, what's the highest and lowest the stock price has moved? And if it's kind of consistent within a band, you might expect it to stay within that unless there's really big news that comes out about a firm. So if it gets close to the top of the band, you might sell the stock. And if it drops down to the lower part of the band, you might buy it and just try to trade off those little movements that happens. Again, this is not investment advice here. Most research evidence that looks at technical analysis finds that it doesn't work sustainably. A lot of people will tell you about their wins in this space, but they won't tell you about their losses. So you might get a blurred outlook about what actually happens here. But anytime someone's trying to do a systematic analysis of this type of investing, it doesn't really lead to much positive abnormal returns. Okay, so the one I wanted to spend a little bit more time about on today, because it's one that does work for a lot of big investment firms, so hedge funds like Jim Simon's Renaissance Tech. Other big quant firms can do this pretty well. A little bit harder to do on your own, but it's still good to know about this piece of the investment world. And this is going to be called quantitative analysis. So what quantitative analysis is using mathematical and statistical methods to make trading decisions. So it sounds kind of like technical analysis, and it actually can be based off of technical analysis. The difference here is the scale, because we're going to use algorithms to try to automate those trades and not have to sit there manually and do it day in and day out. So we're going to program algorithms on our own and then attempt to exploit departures from historical patterns. Forgot to log into Wall Street Journal, so hopefully this works. Oh, sweet. I'll have to log in. Okay, and then Saj, feel free to share these slides if you guys want to see all these links and stuff. So I wanted to show you an example of one of these that is likely priced out of the market at this time, but it's kind of a relatively simpler quantitative signal that's been used in the past. So it gives you an idea of how this will work in practice. Again, the link for this is in the slides. You can also find a lot of these coding libraries out there. There's some links within the article if you're curious about digging into this on your own. What's going to happen is a trader comes up with a signal that they think will work. Maybe it'll be one of these technical analysis signals. This is actually what this code will do, is going to be a technical analysis. But it could also be fundamental things. I'll talk a little bit about other fundamental signals you might see out there. It just depends on what that analyst thinks is going to lead to abnormal returns. What they'll do is they'll create this algorithm that I'm about to go through, and they'll try to back test it. They'll use it on prior historical market data and see how it did, and then the hope is that it's going to work at, out of sample into the future. So what we're going to look at here is it's going to take a list of stocks and rank them based on their relative valuation to each other using what's called Bollinger Bands. This is another technical indicator that's been around for a long time. And it's going to compare firms within an industry relative, and look at their relative prices to trends. So see if somebody's doing relatively well in their industry, maybe they need to do what's called mean reversion and go back to the kind of the average return in that industry, and then vice versa for those that are underperforming. Now what will happen when you start to code, so this is all going to be through Python, is you're going to have to load a ton of libraries to help make this easier. So luckily there's a ton of these resources out there at this point. Quantopian is one that has a lot for quant trading. But this simplifies the way to get data into Python because they're going to have set ways to, variables that you can set so that you can actually automate this pretty quickly and not have to really code from scratch. Okay, so we load in a bunch of libraries. And then we need to think about how this algorithm is going to allow us to trade and how this algorithm could go completely haywire because we forgot to give it specific directions. So it's an algorithm that's just going to do exactly what you tell it to do. And if you forget about things like how much leverage it should take on or how many stocks you should buy, it might just keep buying and buying or keep levering and levering, and you'll run out of, or you'll make it too risky, or you'll run out of debt that you can pull from or something like that. So some things you would want to do when you start this algorithm is say, hey, I don't want to take any leverage above 100%, so I'm going to set that as my max leverage. I don't want to hold an insane amount of stocks, so my long portfolio can only hold 300, my short can hold a max of 300. That way this doesn't get completely blown up. Then you want to think about within this algorithm, how much should I hold in any given stock? So that's what this is doing. How much could I have in any given position? They set it so that it's a scaled version of the overall number of stocks in that portfolio. So maybe it's something like, of my long positions, I only hold 3% in any given one stock as a max. So you can kind of fiddle with that based on how you want to position your algorithm. You also might want to make sure that it doesn't go 100% into one specific sector. You want to keep it really diversified across the market. So that's what's happening here is it's setting a max sector exposure. It's also setting a max beta exposure, so your exposure to the market risk. Now this is the piece of the actual operation that happens within this specific program. Again, what it's going to try to do is say, how has this stock performed? This here it's going to set it for over the last 60 days. And then it's going to compare it to its specific sector. And say, over the past 60 days, is it trending towards the max of this sector, or is it trending towards the bottom? And this one's actually going to assume that they're all going to revert back to normal in the long run. So it'll say those that went all the way, the very highest in their sector, I expect them to revert down. So I'm going to short sell these stocks, bet against them. And those that are underperforming in the market, I think that they're going to revert up and come back from that underperformance, so I'm going to buy them. And it's going to kind of iterate over that, over specific time periods. I believe they set this up to be monthly. And then you also have to think a lot about what stock universe you want to worry about. So here they're going to just look at, I think this makes it the S&P 1500 is what they're going to look at. And you can set specific, do I want to just look at specific sectors, or how big of a reversion do I expect? Let's see if there's one other thing I wanted to mention here. So then we make long and short portfolios. Then we have to worry about other things that are happening in the market in terms of how we actually trade on this algorithm. So if you think about how you trade, you probably use either, say, Robinhood or Fidelity or something like that. And you have to worry about, not so much anymore, but some places you have to worry about the commission that you'll have to pay when you make those trades. And the bid-ask spread, how much is the stock price going to move when I do make this trade. So you can set limitations for that as well. So this algorithm said I only want to trade when the commission is 0, and I don't want, it's called slippage, but it's how much does the price move when I make trades. I don't want it to make very big price impact when I make a trade. Let's see if there's any other things I wanted to note on this. Gets into a few more specific things about beta exposure and market exposure. And then you also set the time to reset everything. So typically it's monthly, so you'll do like a long-short strategy, and you'll rebalance it every month. Declan?
Yeah, so like, will people like, or companies come up with like these models themselves? Like how, like are they coming up with more than just one model? Like maybe they have multiple models that they'll run and then they put into the market, or they're only like putting all their eggs into one basket and like focusing on just one?
The most successful firms, I mean, they're not going to disclose if it's, you know, so there's this Jim Simons, his firm is Renaissance Technology. They're one of the more successful ever quantitative firms, and they will not tell anyone what any of their signals are. So it's hard to give you a perfect answer on this. But my impression is that they're widely diversified across the signals that they're going to run. So they're going to have, you know, if it's $1 billion fund, they might have, you know, 100 different signals within that, and you know, $1 billion divided by 100 goes into each one of these different signals that they're going to test out. They definitely don't want to put all their eggs in one of these.
Okay.
And they're also probably, there's called alpha decay. So if they find something that works in the market, it's probably only going to work for a certain amount of time until somebody else figures this out, and then it becomes priced into the market, and it's no longer mispricing. So they always have to find these new signals.
And that's usually the ones that on the websites, like when they show like this is what.
Like this Bollinger Band one, it's totally priced out because everybody knows about it.
Yeah. Okay, so it's about trying to like create new ones, obviously.
Exactly.
Okay.
Yeah, and that's where a lot of this alternative data comes in as well, because if it's hard to either access that data at scale or process it really quickly, then it becomes harder for people to mimic your strategies. So you could have, you know, a version of one of these trading algorithms, but it's go long number of cars in the parking lot today and short those, you know, with few cars in the parking lot. And that's going to be harder to mimic by other investors because they might not have access to that data.
Okay.
I think Sanj first.
So my question is, like, how is this much different than using a stock screening? Can't I just screen for like a company research
So
data?
that's one way you could actually look at doing this on your own. The problem is it's on you doing it all the time. So this would be updating algorithmically. You could be running while you're sleeping, and you could have, you know, tons of them happening at once because they're all just running through your software. It doesn't require you to do the screening.
Yeah, and then since it's like relatively short term, obviously it's short term capital gains. So how do the returns compare to something more long term, like just investing in an index fund?
Yeah, I don't know how. I mean, for firms like Renaissance Technology, they've done much better than the average market return.
Yeah.
So they typically have years of like 20 to 30% returns in this, but I'm not sure how much they end up paying in capital gains. A lot of them are also, I mean, they're going to have a lot of built-in losses as well. Not every single stock is going to perform perfectly, and they'll be able to kind of wash some of the positive returns with some of the negative returns that they've closed. But I don't know that they disclose like their pre and after tax returns. It's a very good point though. So if you're doing this on your own, your capital gains taxes are going to be huge.
How do you test your algorithm before you visualize it?
So you got to get historical market data to practice this. So you would want to look at, typically what they'll do is if you have, you know, all historical data goes back to like something like 1936 or something, you'll take maybe half of the years and set up your algorithm and see how it works, say from like 1950 to 1990 or something like that. And you try to price out what your returns would actually be if this worked. And you kind of fine tune it in that space, and then you go try to test it in the more recent data and say, does it continue to work after 1990 till today? And if it looks like it's, you know, that consistent, then you might be more confident to use it in the market.
I also found like a safer way to do it as well. Like people can also put it into different stock markets. Like obviously you got the stock market like in America, but like you can also put it into different like, countries.
Mm-hmm.
And like people like at least I know a few people that do it that way. And if it doesn't work in one stock market, but it works in the other, they then kind of think is it worth doing or not.
True. Yeah. No, that's a great. Yeah. Out of
It's
sample
just like an
test.
extra
Yeah.
safety kind of thing.
Yes, absolutely. Or different asset classes as
Yeah.
well. Yeah. So a lot of like these technical, like the crossover and the resistance bands, they maybe have worked at some point in the US equity market, but they're long past working. But then when new markets came up, so people would start to use them in cryptocurrency. And if you were early in cryptocurrency, you could trade on this better because there's a lot of new investors there that haven't seen a lot of these different patterns before. So people are exploiting a lot of old indicators that aren't common in the equity markets anymore, but there's kind of this new market they could teach some new investors on how to trade. Any other questions or comments? Okay. How long am I supposed to go for?
Whatever.
Okay. I think I'm almost done. So some other things in quantitative analysis. So that was just an example of a technical indicator. You can actually do these with fundamental analysis as well, where you try to think more about specific characteristics of the firm and how they related to overperformance or underperformance at a very aggregated level. So if we group firms by certain characteristics and trade on them, is there any consistency in the long run of how they've done? Again, we're still just trying to generate alpha here. I wanted to bring up how we think about alpha more theoretically, and then I'll try to relate that to some different quantitative signals that are out there in the market. So what I'm showing here is, so this formula is a regression formula. So we're trying to relate the excess return on some security I at time t to different risk exposures. So we're going to find the line of best fit between my stock's return, and in this case, it's going to be the market's excess return. So we're going to see how it's related, basically do a correlation between my stock's excess return and the market's excess return. And then this beta is going to tell me how much exposure do I have to the market return. So if it's very high, that means my stock's very responsive to market level risk. If it's low, it means it's less responsive. And then you're going to have some other terms that show up. You'll have like this idiosyncratic risk of the stock, and then you'll find abnormal performance sometimes. This is the very base level of how academics started to think about the relationship between a stock return and market risk. So the very only factor they thought about was exposure to market level risk. And if the common thinking back then was, if you find some unexplained return above and beyond that market risk, then that stock has alpha. This is ballooned up quite a bit. You can see this formula, it's so long you can barely read it because it's in small font. So a lot more risks have been discovered in historical data that show other places where a stock might, or explain what other reasons why a stock might overperform or underperform. This is one variant of these regressions that get run. There's actually hundreds of different factors that people have claimed to have found that predict stock price movements. These are the ones that are kind of the most tried and true as of right now in the academic literature. So here's that market return one. It's just written slightly differently here, but it's still how much exposure does my stock have to market risk. But then these other ones, we're going to have a small minus big, high minus low, up minus down, conservative minus aggressive, and then robust minus weak. And what these do is other characteristics within a specific company, we're going to sort them and look at how those different groups do over time. So for example, this S&B portfolio is going to group small cap stocks and track their portfolio relative to large cap stocks or even mega cap stocks. And if you do that over a very long time period, you'll see that small cap stocks generally have higher raw returns than large cap. Another of the more famous ones is HML, which this is high book to market stocks. These are called value stocks. So if you have a very high book to market, those stocks generally have higher returns than stocks with a low book to market. The rest of these, they follow that similar flavor, but they just look at a different characteristic. So momentum looks actually at just a market characteristic. It's going to group firms that have done very well over the past 3 to 12 months. And those stocks tend to have momentum. They tend to do better over the next 3 to 12 months than stocks that have performed poorly over the past 3 to 12 months. You can also look at investment decisions of the firm. So firms that actually do fewer capital expenditures, so we call these conservative firms, they tend to outperform those that invest aggressively. Declan, we were just talking about this in 30-10 the other day, if you recall. So firms that do less capital expenditures tend to outperform those that do more. And then there's also one related to operating profitability of the firm. So I wanted to show you, we just look at one example of this, book to market. So this is the value version. This is essentially the glorified back test of how this portfolio would do if you tried to trade on this. So you say, let's go back to 1965, and we're going to group all the low book to market stocks. So I believe this is just the bottom 10% of the entire market index, who has the lowest book to market, and then we're also going to compare it to those with the highest book to market. So what my figure's showing here is if I just invested $1 into each of those groups, I would take my my value stocks. That's going to be this purple line. I'll put $1 into those versus what would $1 do in the growth stocks. And you can see it's not always perfect, but in the very long term, the value vastly outperforms. So it's something like $1,200 is what that $1 is worth today versus say 175 in the growth stock portfolio. And this is how it's done for all of those different characteristics. People will do these back tests and just see how significant is the difference between these two groups of stocks. And then you can also compare this to say the market return and see if you actually have abnormal performance above and beyond say the S&P 500. So here's just a little bit more, again, this is just for more takeaway stuff if you're curious to look more into this. Again, you're going to make these long short portfolios to try to examine the magnitude of these returns. There's another coding example here I'm not going to go through, but typically if you want to automate these things, you have to be comfortable in either something like Python or R to do it algorithmically. Or like Sam's brought up, you could actually use stock screeners as well and do manual groupings. If you wanted to just trade at the monthly level, you could just go to something like Finviz and just do, here's price to book right over here. So you can just look for those with the lowest price to book, and then you can group and find those with the highest. So you can do those actually pretty quickly if you're trying to trade at a lower frequency. I only really brought up like 5 of those different trading strategies when you think about fundamental characteristics in quantitative investing, but there's hundreds of them out here. This is just a link to an academic paper that gives you the basis of them across all different asset classes. Yes?
The 5 you showed, are they just like the most common ones, or are they ones that you think?
So they're the most time-tested and robust ones.
Okay.
So they're the ones that have actually been, they've been brought up for a long time and they seem to continue to work. And there's actually some, back and forth on how well they work. The small minus big one has the most criticism. Like recently, it hasn't done very well at all.
Yeah.
So they have like spurts of time when they don't do as well. But from the hundreds that have been looked at, they seem to be the most robust and continuing to work.
Okay.
Yeah.
Is there an algorithm for when to sell shares too?
So that would be, the way these work are basically, I guess it would be this figure. These are selling every month. You basically rebalance it. So when it falls out of basically this low book to market, you want to sell it. Or if it falls into here, then you're going to short sell it, kind of thing. So it's just, who's consistently in the buckets that you are trying to filter. But it's typically, the signals, all of these ones that I've shown you have been part sell. Because you have a long portfolio, you're buying these, and then the short portfolio, you're betting against. Some things, so like the satellite data analysis we did actually works a lot better on the short side. So if you can't really short on your own, you're kind of limited to how many of these you can use, because if you're just doing the buy side, you're only getting, a quarter of the overall outperformance. And that's just, that's what we call limits to arbitrage. Not everybody can short very easily, but there's sometimes still signals at the long end as well. All right, I think that was it. Yeah, so just a few takeaways there. So information is key to market movements. Just remember there's always somebody on the other side of the trade. It could be someone who you just disagree with their own analysis and maybe you're the smart one on the trade, or it could be $1 billion hedge fund with a lot better information than you. So just think about that when you're making trades. Yeah, the market mispricings can be identified. You just got to make sure you're actually finding mispricings and not just an unexplained risk exposure. Did you have one more question, Declan?
Yeah, with the quant trading, like you said, like there's that screen, whatever.
The stock screener?
Yeah. Stock screen. Do you think like the first thing where you create your own algorithms and Python and stuff, you think that's like someone, an individual can do themselves, or you think that's like pretty much only like big companies can do?
Oh, you could definitely do it. I mean, it's much riskier, I think, on your own because you're not going to have as many checks and balances in the algorithm writing procedure, so something might go haywire on you.
Yeah.
But it's definitely possible. So this. This article links to a site, which is ironically, I think they might have shut down. So maybe it's not the best advice to do their trade. But there's like legacy versions of this as well. But this Quantopian thing is all user generated. So it's all just individuals doing this, but they give you all of their, I don't know if they have like a subscription or something like that, but they give you access to all of their libraries, and it's all just individual investors, and they have like a forum where they give recommendations, and it's all just non-professionals doing it on their own. So it's been done before. Yeah?
Does the algorithm actually queue the trades in for you?
Yes. Yeah, so it completely executes it on your behalf. I mean, you could set it up to do that. You could also set it up to like just give you a list, and then on the first of every month you review it and then make the trade yourself. But it definitely can do it for you. Like high frequency traders are doing this at the microsecond, so it has to be executed, or because a human couldn't even buy it or sell it that quick. Any other questions? Yep.
What makes would you say are best suited to get into quant?
I mean, so the people who do it professionally are coming usually from computer science backgrounds. So it's a lot of computer science work, and it's also a lot of statistics background. So coding, but then also understanding, general distributions and econometrics is also very important in this space. People from the finance side, like if you have a finance degree, they'll go into this, but you generally need to have some coding skills if you're going to do this. Yeah.
Is it that hard to learn the basic coding for this? Like, is this actually like a really like sophisticated, complicated coding, or is this like?
It used to be, but I mean, with ChatGPT and different AI coding assistants, you can get up and running and doing this surprisingly fast.
Okay.
But yeah, I would suggest playing around with that. Just go ask ChatGPT, give it a signal that's been you can bring up the Bollinger Band or something like that, and ask it to write you a quant formula, and you can tweak it, and then go test it with $1.50 or something like that. And it's not perfect, but it gives you the guidelines, and then you can kind of Google around on different forums to find where it messed up. But it does incredibly well. So the startup costs are not nearly as high as what they used to be.
And have you done stuff in quant trading before?
So I haven't in a long time. So when I was a portfolio analyst, you're like heavily restricted on how you can trade personally, because you're going to get in trouble if you trade in front of what your clients do. And then I really haven't gone back to it since, because I was just so busy with the PhD program and the research side of things. So I haven't done it in the modern era of this trading.
So when you were managing portfolios, were you doing that through fundamental then? Or were you doing
Yes, that was all fundamental.
So 161 did.
Right. Okay. Yes.
So I saw this You mentioned the Taylor Geospatial Institute earlier. Did you ever do any work for them, or?
So I have a grant with them, and I have like basically an affiliation with them because some of my research, so like satellite imagery data is technically geospatial work, but then I also use the cell phone ping data in a lot of research. So geospatial data that tracks phone movements and looks at that in various finance applications. So it's kind of affiliated with them, but I haven't done any like consulting work here. Any other questions? All right, well, again, so I'm Professor Painter. I'm here in the business school. If you have any questions or anything, feel free to stop by. I'm in DS 301, or you can find my email on the business school website if you have any other questions. But yeah, thanks for coming. This was fun.